Peter Lynch was one of the greatest investors of all time. As a manager of the Magellan Fund at Fidelity Investments from 1997 to 1990, Lynch averaged a 29% annual return, consistently more than doubling the S&P 500, making it the best performing mutual fund in the world. In this 1994 recording, Lynch shares some of his investment wisdom that has helped make him and his clients millions. In this specific excerpt, Lynch shares advice on how to deal with a falling stock. At the end of this clip, we'll elaborate on Lynch's points and demonstrate examples of how you can put his advice into practice within your own investment portfolio. So sit back and enjoy.
Is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company. It was just so overpriced. It went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, "How much lower can it go?" It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, "Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, "There's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, "Everything's fine, and eventually this will work out." And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you were just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The Psychological Psychiatry Fund, I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, "I'm thinking of buying this stock at 3. How much can I lose?" Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1.25. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know,
Like a true master of his craft, Peter Lynch does an incredible job of conveying his investment knowledge in such a concise and entertaining way. We'll now elaborate on 3 of the key points that Lynch discussed and how we can apply and incorporate that knowledge within our own investing habits. The first key point is simply buy what you know, and also conversely, if you don't know, don't buy. Now, at first glance, this advice might seem so obvious and simple that it doesn't really add much insight. However, it's actually a surprisingly common trap for investors to fall into, especially new investors who may not have much investment experience. By understanding what you own, you have a better sense of the value of the company and the potential upside and downside in different scenarios. It's only then that you can make a rational evaluation of the potential risks involved with an investment. This concept is also referred to by Warren Buffett as investing in your circle of competence. Your circle of competence being the group or subsection of companies that you know quite well and fully understand. While it can be beneficial to increase your circle of competence over time, investing outside of that circle of competence can often lead to investment mistakes because you simply don't understand what you're buying. Peter Lynch is also an advocate of using your own local knowledge and personal experience, which can sometimes help give you an edge as an individual investor. I'll give you a couple examples from my investing experience. One stock and business that I know fairly well is Kroger, the largest pure grocery store in the United States. I've been shopping at one of their subsidiaries, Harris Teeter, for most of my life, so I've got a pretty good sense of their core business model as well as the preferences of their average consumer. Flashback to 2017 though, and Amazon has just announced their purchase of Whole Foods. Many investors ended up dumping Kroger's stock as the stock price dropped almost 30% in just 2 days. The rationale behind this was that Amazon, with now Whole Foods, was likely to take more market share as well as compress margins for Kroger. However, based on my own consumer habits, I wasn't planning to now jump over to Whole Foods just because Amazon bought them. Even after a first wave of price cuts at Whole Foods, prices were still generally cheaper at Harris Teeter, so in my view this was an overreaction in the stock price, and I ended up picking up a fairly large position in Kroger, which remains one of my largest stock positions today. However, if I didn't understand Kroger and their customers, I too would probably be quite concerned with Amazon entering into the field with Whole Foods. Now, I would be remiss to give you only a positive example, so I'll give you an example of a big mistake I made much earlier into my investment career. So this goes all the way back to 2013, and this time deals with the stock of Apple. Now keep in mind, this was when I was just first starting out investing, so I really didn't have a great sense of business fundamentals and stock valuation. About a year prior, in 2012, I bought Apple stock simply because I just genuinely liked the products. I had had several iPods in the past and was now very enamored with my new iPad. But in 2013, Apple saw one of its first declines in iPhone sales revenue. And from September 2012 to spring 2013, the stock price of Apple dropped roughly 40%. Now in that winter, I remember exactly where I was in the undergraduate library as I was planning to sell my Apple stock. At that point, the shares were already down roughly 25% off of all-time highs, and I was concerned that I might lose more if I continued to hold the stock. This is ironic because in that same memory, I vividly remember seeing and looking around me in the undergraduate library. All the students had not only iPhones on the table, but also had and were using their Mac laptops. So given that I didn't really put 2 and 2 together in terms of the insatiable demand for their products, and also wasn't aware of the fundamental valuations, and at the time, Apple was trading at a price to earnings ratio of 10, which is an incredible value for the potential growth prospects that Apple had at the time. Despite all of that, I ended up selling my shares in Apple, split adjusted at around $65. Now you can do the math, but those shares today would be worth nearly 5 times more had I just held them for the long term. So that gets to a good lesson learned, is that if you don't understand the stock you're buying or whatever investment you are buying, and the price falls, you won't have any metric to evaluate whether the price decline is justified or not. This could cause you to sell a stock prematurely to cut losses, when in reality, market volatility simply causes stock to become undervalued in the short term. On the other hand, you could also end up continuing to hold a stock that has fundamental issues you may not be aware of. Overall, if you stick with investing with businesses you understand, and especially those you have local or specialized knowledge in, you will be much less likely to get into trouble and lose money investing. The second key point Lynch discussed is the myth that a stock will come back. Well, over the long run, an index like the S&P 500 has historically gone up. That isn't a guarantee that all the individual stock components of the index will go up as well. Many stocks do, but some businesses eventually face challenges and never end up recovering. Going back to our first point, you need to understand the fundamentals of the business. If you don't, when the stock falls, you're instead only really hoping that the stock will come back. And unfortunately, in the long term, hope is not an effective strategy. So when the price of a stock declines, whether this is a stock you own or a stock you are watching and potentially might consider owning in the future, you should ask yourself some questions. Is the decline in the stock price justified in relation to the business fundamentals? Going back to my examples with Kroger and Apple, it's possible that price declines may be short-term in nature and potentially overreactions to what would otherwise be stable or improving business performance. However, for some richly valued stocks trading at high multiples to business fundamentals like earnings, cash flow, or sales, if investors are paying too high a price for an excessively valued stock, there's no fundamental reason for the stock to come back to a price it was never justified trading at to begin with. This is a risk in investing in some very high valued growth stocks, which could potentially see a permanent reduction in valuation multiples. The underlying business may still be fine and growing quite quickly, but the stock was simply trading too high, similar to the Polaroid example that Lynch provided. Another question to ask yourself is, are you evaluating the business based solely on past performance? While many businesses are relatively stable and past trends may be similar to future results, looking only at the past can get you into trouble if you miss changing industry trends that will impact the business materially in the future. Just look at most retail stores. With the exception of some big box and discount retailers, many of them have not and will not likely recover to their past peaks. In fact, many of them may cease to exist entirely. When looking into a potential company to invest or evaluating a stock price decline, I will often check for potential red flags which could signal a deterioration in the business performance going forward. Overall, don't jump into a stock solely because of a price decline under the assumption that it'll go back up to its previous price level. You have to understand the underlying business fundamentals to make a rational assessment on whether or not it's an attractive investment opportunity at the now lower price. And finally, the third key point that Lynch discussed is a low share price does not mean low risk. And on another note, a low share price doesn't necessarily mean that a stock is cheap either. A stock can have a low share price, but also be relatively expensive compared to the actual business fundamentals per share. Conversely, you can also have some stocks which may appear relatively expensive based on their share price, like Alphabet or AutoZone, with share prices over $1,000 each, which could actually be cheap by some fundamental metrics like earnings or growth. Understand that share price alone doesn't tell you any information in relationship to value. And as Lynch discussed, you don't have any less downside investing in a stock with a low share price. 1,000 times 0 is the same as 1 times 0. And I'll give you a hint, they're both 0. A recent example of this might be taking a look at the stock of JCPenney. Now, investors of the past seen a cheap share price of $5 per share might be willing to bet on a turnaround of the struggling retailer. Applying anchoring bias to the previous all-time high back in 2007 of $85 per share, the stock was already trading down 84%. How much lower could it go? Well, the shares recently traded in May of 2020 for about 25 cents per share, or a loss of 95% from that $5 share price. If anything, seeing a particularly low share price is likely a warning sign to look into the business further, and many times these stocks are better off avoided altogether. So those were just 3 key pieces of wisdom from Peter Lynch, and there's so much more out there, but hopefully that helps give you a little more perspective on the thought process and what you should do to handle dealing with a falling stock price. If you like more content like this, analyzing videos from great investors, let me know by leaving a like on this video, and if you're new here, consider subscribing to get access to more content like this in the future. Until next time, thank you so much for watching. My name's Michael, and I will see you in the next video.